This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 102.5 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans. Or you can talk to him right now at 407-916-5400.
Are you caught in the return gap? We'll tackle that this morning on the program, along with talking about some articles that we posted recently on social media, one involving 401ks and what to do with them and how neglecting them ultimately leads to your not generating nearly the retirement that you hoped for, plus an article featuring some of the Social Security mistakes that people make out there. The list is long on those because, well, Social Security is typically a vital component of people's retirement income, and if you mess that up, then you sort of mess up that whole retirement thing. We'll recap the week that was, got some commentary on a couple of items on that. And, of course, we will open up the program to whatever topic you'd like to discuss. In order to let us know what the topic is, though, you have to do one of two things. You either pick up the phone and dial us at 407-916-5400, toll-free 1-855-545-1025. Or option two, if you want to not get on the air, is you can send us an email. That email is my first name, Joel, Joel, at NelsonFinancialPlanning.com. Those are the ways that you can get in touch with us and add to our laundry list of topics on the program this morning. Good morning. It looks like a beautiful day out there. You're listening to Dollars and Cents. We are Central Florida's longest-running radio program. Started in the early 80s by my father-in-law, Jack Nelson. Continued today by me, yours truly, Joel Garris of Nelson Financial Planning. Been on this station nearly all of those years. I think there was one year where we were not on this station or some precursor of this station. But we certainly do like the folks at News Radio 102.5 WFLA. So the week that was, certainly the headlines were more about the Federal Reserve and the economy as we look at what's happening out there on the unemployment numbers. It certainly is showing some pretty good numbers across the board. The numbers of unemployment continue to improve, with the economy adding a bunch of jobs in July, causing the Federal Reserve, I guess this is sort of the bigger news this past week, causing the Federal Reserve to basically sort of shift its language and say, well, instead of being good or in terms of the economic activity, they changed that language to refer to the economy as strong. So things seem to be doing quite well. Then the markets themselves, the S&P 500, which is the broadest indicator of the overall market, finished its fifth consecutive week of gains, almost back to, not quite, but back to where it peaked earlier in late January, early February of this year. Another bit of headlines that came out was, and if you listen to the program in the past, you heard us talking a little bit about that, the capital gains tax cut that is floating around Washington may appear to be getting some level of traction simply because it continues to sort of resurface. It's one of those topics where if a topic keeps resurfacing, right, you have to maybe think, well, my goodness, is that potentially a topic that will continue to actually get some real implementation in the law? And the topic in particular is this capital gains adjustment, if you will, that would effectively cut capital gains taxes by allowing investors to factor in inflation on top of their cost basis for an asset. When you sell an asset, that generates a capital gain. Typically, you have to go to your basis. If that basis was 30 years ago, then that means that you've got a very low basis that has not been adjusted. With this inflation index proposal, you would wind up actually being able to increase that cost basis based upon a rate of inflation. I'm still not sure how much legs this one really has, although it does kind of keep popping up a little bit every now and then, simply because if you reduce the capital gains tax, then ultimately the government winds up not bringing in that amount of money. And last we checked, the government was having a bit of a problem having its expenses be more than its income. So I suppose stay tuned on that one. I do question whether that has legs, but it keeps resurfacing. So stay tuned on that. The week that was saw a lot more of the earnings rolling out. Now you've got 80% of the companies of the S&P 500 having reported their earnings. The earnings growth rate still, again, for the second quarter, still pretty impressive at 24%. That's up 20% from what was expected at the beginning of the earnings season. Revenue growth up nearly 10%, which is about an 8% increase from what was expected. So the numbers for corporate earnings season, which is this time of year, we're starting to get into the back end of it. Those numbers really are pretty impressive, very close to a 25% earnings growth rate and a nearly 10% revenue rate increase for the second quarter. Certainly pretty impressive stuff, to say the least. So corporate America continues to do well. We've got one of the biggest earnings this past week was Apple, which pushed Apple above the $1 trillion mark. Apple becoming the first company whose market valuation reached $1 trillion. That's pretty impressive for a company that was nearly going bankrupt 25 odd years ago. Certainly a testament to the leadership of the late Steve Jobs to turn that company around and cross that threshold that no other company has crossed, the $1 trillion valuation. So certainly and then of course the economic growth numbers continue to come out above that 4% number. Also a pretty impressive string of economic and earnings events. And so that's always good news when that happens, right? Particularly if you're an investor in anything that is stock market related, because if companies are earning money, then obviously generally there is a link between companies earning money and the market doing well. So that's the week that was. Certainly a week that generated a lot of headlines. Back and forth on the tariff stuff. That seems to be playing out every week. The reality is that so far the market really has not kind of given that whole back and forth tariff stuff a big yawn. I think the expectation is that ultimately there will be some resolution on it. And so consequently, then the market isn't nearly as frightened, I guess, as one might think. Speaking of frightening things, what to do with your old 401k? That's a decision that frightens many people. We posted an interesting article about really talking a little bit more about the psychology of that and ways to think about those types of financial decisions. The article we posted on our various social media came to us via the New York Times, basically suggesting that if you leave your 401k alone and sort of forget it, then that's not necessarily a good idea. We'll talk about why that isn't a good idea when we get back right after these messages. You're listening to Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio 102.5 WFLS.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
So here's the article we posted from the New York Times on the social media. I'll just read the first couple of paragraphs, and you can draw the conclusion, or we'll give you some things to think about. For years, I had a 401k for my first job that sat neglected, quietly collecting meager interest as I willfully ignored it. I wasn't necessarily scared or intimidated by deciding what to do with it. Roll it over, change the investment allocation, leave it be. I just never wanted to address it, so I didn't. Now, years later, I'm kicking myself thinking about how much money I left on the table by ignoring it for so long. Sound familiar? Interestingly, the article goes on to quote a University of Florida associate professor of marketing whose work focuses on how people make choices. The choice of what to do feels somewhat very cold, and it's something that you just don't want to do. That's not good, right? If you've got money, right, and you're just ignoring it for the sake of ignoring it, that's really not a good decision. So as much as it might pain you to do that, and understand that many 401k providers have intentionally set up a process where when you're trying to transfer funds, it is not easy. There's roadblocks here, there's roadblocks there. There may be one person that you're dealing with that's giving that's sort of the contact person, but then there's the other entity that's actually the safekeeper or the warehouser of the assets. And oftentimes you don't really have any idea as to who to go to between those two. Because what they'll also do is they'll kind of pass the buck back. Oh, well, we need this from them, or we need that from them. And you wind up kind of getting caught in this back and forth process. Then you may find that, well, there's some paperwork that you've got to do on that. Then they've got to send you the paperwork, and then they can't fax it to you. They can't, the paperwork, it must be mailed to you. So when you go through this process of trying to move money, these types of hurdles are hurdles that are set up by the financial services industry to maybe, in the off chance, if they make it difficult, or one more thing that you got to do, or one more person that you got to contact, or one more person that you got to sign off on, or a notary stamp or a signature guarantee stamp, or whatever the case may be, if they can put up all of those little barricades, eventually you might just get to the point where you say, just forget it. Just forget it. It's not worth it. Guess what? That's exactly the reason why they make that difficult. Because they're hoping that ultimately you'll just get frustrated, throw up your hands, and as this article starts out, just simply ignore the money. Not bother to do anything differently because it's just too hard. So you willfully succumb to those hurdles, and ultimately the money stays where it's at and nothing happens. That's the biggest problem in 401ks. I'll tell you what, 403bs are even worse. 403bs are even worse when it comes to accessing that money to put it into your own name so that you can efficiently plan your taxes and your estate, which is only available in an IRA. If you've been listening to this program over the course of the past month, we've told a particular story involving some advice that was given by the plan provider that is costing dearly the ultimate beneficiary of a 403b account, costing in terms of the taxes and how much more money they have to take out over the next few years rather than being able to spread that out over the course of their lifetime. These hurdles are there. They are intentionally put there to help keep the money with the provider because, after all, that's how the provider gets paid, based upon the assets that are sitting there. So if you've got that old 401k, if you've got that old 403b, much like this New York Times article talks about, don't be intimidated by it. Don't ignore it. Just know that you got to roll up your sleeves on it and you got to go through the process. And it'll be a long process because they'll keep changing exactly what you need to do. Oh, well, we didn't know, and this was a little unclear, and that was not really, you didn't dot that I, and you didn't cross that T, and so we just didn't know what you really meant. Well, come on, give me a break. You didn't know when you got rollover paperwork that at the end of the day, you really were just, really unclear as to what you were doing. No, it wasn't unclear. Okay, you just chose to try and drag the process out as much as you possibly could. That's the problem. The reason that it happens is the provider is just hoping that at some point you throw up your hands. But it is a process. So if you've got an old 401k and an old 403b, be prepared, sit down, roll up your sleeves, and get to work on it. We have dedicated people in our office that do that. It is a long, tortuous, painful process. Needless to say, I'm glad I don't have to do that. I'm glad that's the job of Rob and Christina at the office because it's a drawn-out, painful process of chasing a tail oftentimes. So imagine how hard it is for you to do it if we have dedicated people in the office whose job is to make sure that stuff gets done. And they do it every day. So be prepared. But, folks, it's so important to do that. It's so important to take the time to roll up the sleeves, to really look at it, to really get through that process. Otherwise, it just languishes there. And you forget it, and then the plan changes, and then you wind up dumped into one of these, cookie-cutter target date funds, or worse, you wind up going into some other default option because you haven't done anything with it, and the money just continues to sit there unbeknownst to you as to what's actually happening with it. So I want to encourage you, if you've got an old 401k or an old 403b, to really take a moment, roll up your sleeves, and just plan for a process in front of you. If you need help, shoot, that's where our office comes in to help with that process. We got folks that, Rob and Christina, that do that every day to work through it. And it is a process. And they do erect as many hurdles as possible, hoping that at some point you will just throw up your hands and say, okay, forget it. This is taking too long. Okay, this is very frustrating. And certainly it is. But it's important to be able to get through the process, because otherwise the money continues to languish. So some thoughts on that. Don't let it languish. Look at those statements. You would have just gotten all your statements on your accounts over the course of the past 2 or 3 weeks. And that's a good time to look at those statements now that they're still sitting in the mail and hopefully haven't quite hit the trash yet, or the shredder. Hopefully the shredder if you're doing that. And at least you've got the statement. The statement is at least the starting point to be able to start to make some calls and figure out exactly what the process is. So be prepared, but don't let it languish. Because if you let it languish, as the New York Times article points out, you will lose money and not be in as good a shape for retirement as you hope. We'll take a break. When we get back from the break, we'll cover the other article, and then we got to get to this return gap. Are you caught in the return gap? But next up, we'll talk a little bit about Social Security here on Dollars and Cents. This is Joel Garris, News Radio 102.5 WFLA.
This is Bud Hettinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, Dollars and Cents, here on News Radio 102.5 WFLA. This is Joel Garris. You're listening to Dollars and Cents. On the program, this segment, we're talking a little bit about Social Security. Mistakes that could cost you a fortune. An article that comes to us through CNN, and one that we posted on the social media networks that we're on, all of the ones that you would expect us to be on, like Facebook and LinkedIn and, all those places. Anyway, the article, among many mistakes that you can make, highlights 3 in particular, which we will highlight for you as well. Claiming too early if you're still working. Most people sort of forget that, hey, if I'm not my full retirement age, which for many people is getting to be 66 and change, or even 67, if I start to collect, but yet am still working, meaning earning income, and that number is about $17,000 for a year, then at the end of the day, you wind up having to give back some of that Social Security. Why is that bad? It's bad because when you take it early, you elect for a permanent reduction in your Social Security benefit. So if you're electing for a permanent reduction, and then you have to turn around and give back that reduced amount because you're still working, then that's not a good scenario, right? So be careful about that, because the notion of claiming too early if you're still working is a pretty significant one. Another one is spousal benefits. A lot of people don't realize about spousal benefits that you can look to collect under your spouse's record and basically suspend taking on yours, which means that yours might be able to accrue on up so that it is a higher amount, which means then that you've got to really consider how your Social Security retirement benefit would work versus collecting under your spouse's record. If you, the reality is that this is particularly applicable where one spouse may not have a full work record. Remember, Social Security is calculated based upon your 35 years of working, your highest 35 years. So if you've got a gap of 10 or 15 years in there somewhere, then ultimately that's going to bring your average number down, which consequently brings your Social Security number down as well. So one of the things is to really look at that spouse's record and to see where that might be better off for you if you collect on theirs. Meanwhile, it gives yours an opportunity to sort of be left alone and ultimately might lead to getting more money later on because you can change over to your record. And another area which is prone to a lot of mistakes is your earnings record. Now, obviously, with technology and computers these days, that probably happens on a less frequent basis, but it still happens. And certainly those early years are the years where you want to really be looking at your earnings record that you get. What's interesting here is Social Security used to send out everybody an annual statement. They don't do that anymore. It's a little bit hit or miss. They'll send it out to you on your 0 and 5 birthday, so 50, 55, 60, that kind of thing. But here's the exception. If you've ever signed up with them online, well, they don't send you it anymore in the mail. You have to then turn around and remember your password and get online and to try and pull it up from there. So that Social Security statement has a lot of that information in terms of what your expected benefit is going to be, along with your earnings statement. It used to come automatically in the mail. That was easy. The reality is that now you've sort of got to, find it and look for it, because it's always good that you wind up matching up your earnings to what's on that statement. And you may say, well, how could they possibly miss it? Well, this is the government we're talking about. And what Social Security Administration has, in fact, reported, the last available year was the 2012 tax year. The SSA, Social Security Administration, said that $71 billion in wages couldn't be matched to any earnings record, and that only about half of these mismatches were eventually corrected. So you've got $71 billion that couldn't get matched up, and if your money's not getting matched up to your Social Security earnings statement, guess what? It doesn't count. It doesn't help towards you getting a Social Security check. And at the end of the day, with $35 billion still completely unresolved, that's a lot of wages. That's a lot of money. So you may think, well, come on. I mean, how Social Security doesn't know that? How do they not match that up? And the answer is, I don't have any idea how they mess that up like that. But for the most recent year that the numbers are out, it came to $71 billion in wages that couldn't be matched to any earnings record. So if you don't think it's important to check your earnings record, you're missing the point. Social Security certainly is not perfect on how it matches stuff up. I'd say a $71 billion mismatch is a pretty big mismatch. So double check those earnings statements. Make sure that what's on that record is reflective of what's on in your taxes and what's in your actual earnings record. Got to make sure they match. So those are just some of the bigger mistakes or issues with Social Security that people often overlook. Thought it was an interesting article out of CNN, and so that one is also up on our social media channels as well. So those two in particular, the Social Security one and the 401k getting ignored, are two articles that we've posted over the course of the past couple of weeks. So if you'd like to read those articles or find out more about them, they are available on places like Facebook and LinkedIn. To find us on Facebook, you just need to find Nelson Financial Planning, and then you will find those articles. So be sure and check that out so you can read the full context of these articles. So, the return gap. Are you caught in it? What exactly is it? What does it mean? The return gap is pretty significant. It's defined as the difference between the average return of a fund or the markets and what the average investor actually experiences in returns within that fund. So this study comes to us through a professor of finance at George Mason University and courtesy of the Wall Street Journal. And it gets into this return gap. And if you don't think it's significant, wait till you hear some of these numbers. This study looked at investors' performance in a fund versus the fund itself. It's going to surprise you just how big that gap is, particularly when times are tough. We'll have those numbers when we get back here on the program. You're listening to Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 102.5 WFLA. Talking about the return gap. What is the return gap, after all? Well, it's really a pretty damaging gap. It's a damaging gap in that it ultimately reduces your investor return. The gap looks at the difference between the average return for a fund and what the average investor actually experienced in returns within that fund. Okay, so you got the fund, okay, and what the performance is just of that fund, and then you look at the investors that own that fund, well, and they've got a totally different performance number. And that performance number is lower, it's not higher, it's lower than what the fund itself has done. That is known as the return gap. As you might well imagine, much of that can be attributed to the average investor pulling their money at the wrong time, panicking, reacting, overreacting, and so consequently, they don't come anywhere near experiencing the full return of owning a particular fund. Here's where it can get pretty ugly, is when the market has a significant decline. That's when that return gap can get significantly great. So we'll go back in time. 2008, 35% drop in the markets. 2009 was a very positive sort of recovery year where overall the markets were up 26%. So you got a drop of 35 and an up of 26. So that means that the average return for a mutual fund over that 2-year period of time, 2008, 2009, was somewhere near minus about 4.5. Very simple math. Okay, down 35, up 26 the next year, divide by 2, that's, negative 4.5. Here's how many investors fared. Many investors had an average annual return much closer to minus 17.5 over that 2-year span. So imagine this, minus 4.5, but instead you were getting minus 17.5, minus 17.5. That's a 13.5% per year differential in those years where it mattered most, 2008, 2009. Why? Because very simply, you experienced the down 35, but wound up getting out of the market and did not experience the up 26. That is the very heart of the return gap. And folks, that's probably one of the biggest issues that any investors face. Had that big of a gap in the return is not because the markets or the funds are not behaving. It's because investors are not behaving. It's a pretty significant gap that ultimately winds up costing investors a tremendous amount on their retirement. Interestingly, the folks at Vanguard did an analysis and a study of something somewhat similar to this return gap concept and concluded that one of the biggest roles that having a financial advisor serves is to make sure that you don't get hit with this return gap. In years like 2008, 2009, simply by staying invested and listening to a voice of reason, guess what? That's a 25% difference in your portfolio. Because the vast majority of people got out after it went down 35 and missed out on the up 26. So 25% difference in your portfolio, that's pretty significant. And that was sort of Vanguard's conclusion on its study, is that if you're using a financial advisor, that's where their biggest value comes into play. It may not be every month, may not be every quarter, may not be every year, but there's periods of times when the market doesn't behave and when the advice that you get ultimately can contribute a huge amount to the overall performance of your portfolio, effectively reducing down this return gap. It's not that the fund isn't performing, it's that the investors that own the fund aren't behaving properly. So know that that exists out there and make sure that you do not overreact. This Vanguard study that they did a number of years ago actually wound up being quite interesting and effectively shifting the perspective, even at Vanguard, which has long held itself out as a no-load type of company where, you know, it's all great for do-it-yourselfers. Even Vanguard concluded that, hey, doing it yourself winds up leading to a pretty substantial return gap. And effectively, the Vanguard study sort of confirms this university study out of George Mason University that was featured in the Wall Street Journal a couple of months ago, that is a difference. And it winds up being a difference of a couple of percentage points per year over time. So that's pretty significant, right? Because if it's 2% per year over time, basically over a 30-year period of time, that means you're going to have half as much money as you could have. Well, that's pretty significant when you stop and think about it. You might say, well, 2%, that doesn't necessarily mean much one way or the other. But my goodness, 2% over time is a huge amount that ultimately cuts the amount of money that you save for retirement over the course of your working career in half. So this return gap is a pretty significant issue, pretty important issue that many investors don't understand or appreciate simply because they get too caught up in the headlines. The return gap is most at risk or widest when things in the market don't go the way that you want them to go. That's when the numbers can really get pretty dramatic and make a pretty big difference, particularly in that example that we gave for 2008 and 2009. So mind the return gap, if you will. That is a pretty significant difference and a pretty significant effect that can have on your overall portfolio. Well, let's see here. As we get to the final few minutes of the program, we wanted to take a moment and sort of wrap up some of the topics that we had talked about during the course of the program today. We've certainly covered a lot of territory. Probably most important is the one we just covered, which is making sure that you're not falling victim to that return gap. That's a pretty significant issue. There's a number of different studies out there that really put that number around 2 or 3% per year that can happen to the average investor. So be aware of that and how to avoid it. Make sure that you are ignoring the headlines and also looking for some guidance along the way, some advice along the way, if you will, to help make sure that you are not overreacting to what's going on, because that is a pretty significant gap. Social Security, isn't that a fascinating number that we gave you? $71 billion in wages that don't match up in a single calendar year. If you're not checking your earnings record for Social Security, you really should be. You really need to take the time and find that statement or look for that statement so you can confirm what those numbers are. And then certainly on 401ks and 403bs, those accounts can often get forgotten because there's such a hurdle to get through to move those accounts over to where they are more directly under your control. We encourage you to take the time to be able to do that. Look, folks, that is a process. It's intentionally set up that way, unfortunately. The financial industry has done a great job at trying to erect as many hurdles as possible so that if you're looking to move your money around through the use of multiple providers and multiple addresses and multiple paperwork and multiple forms that need to be signed, it is a process that ultimately can get delayed and often does because of those barriers that are erected by the financial services industry in an effort to ultimately get you to the point where, all right, fine, I'll just throw up my hands, I'll leave it where it is, I'm out of patience on this process. That's intentional. That's the way that they like to do that in order to make sure that ultimately, you get to the point where you are throwing up your hands and saying, forget it, I'll just wind up going and leaving that right where it is. The problem when you leave it right where it is it often winds up getting rejiggered over to like a target date or similar type of fund. And ultimately, you don't really know where or what that money is doing for you. Combined with the fact that there are some significant tax and estate planning issues that occur if you leave your money in a 401k or a 403b. You must roll that over to an IRA. We've certainly been sharing with you the story of someone who did not, someone who was convinced by the provider, oh, leave it right where it is. There's nothing wrong with that. It'll be okay. You can have the exact same features and whatnot that your spouse had. We'll leave it right where it is. The problem is that can create some massive distribution requirements and tax requirements on your subsequent beneficiary. So be careful of that stuff. Don't let those 401ks or 403bs just languish. Get on it, but be ready. Roll up your sleeves and have the patience to go through that process that is quite difficult at times because the current custodian doesn't really want to give up your money. Even though it's your money, I'd prefer it just stays in their hands. Work through that and ultimately get on top of how that 401k, 403b assets are really performing rather than just ignoring them and letting them languish. We are out of time, so we will wrap it up. Thank you all for listening. This is Joel Garris of Nelson Financial Planning. You've been listening to Dollars and Cents on News Radio 1025 WFLA.
How have your investments performed over the past 5 years? Do you know? Are you happy with that number? At Nelson Financial Planning, we've been achieving investment results over the past 30 years using actively managed investments that we own personally. This is Joel Garris, and I invite you to review your investment results with us. Visit nelsonfinancialplanning.com or call us today at 407-629-6477 to set up a conversation to review your investment performance. That's nelsonfinancialplanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC at FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 1025 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.